Imagine needing to access your hard-earned retirement savings before age 59 and a half, but facing a steep penalty just for touching your own money. It is a common concern for many who are considering an early retirement or facing an unexpected financial need. Fortunately, there is a special provision that can help you avoid that extra cost. You can avoid early withdrawal penalties by using Internal Revenue Service Rule 70-T, which allows you to take what are called substantially equal periodic payments from your retirement accounts without incurring the usual 10% penalty. The early withdrawal penalty of 10% is typically applied to distributions from qualified retirement plans before age 59 and a half. This rule is designed to encourage individuals to save for their long-term retirement rather than using funds prematurely. However, the Internal Revenue Service created Rule 70-T to offer a specific exception for those with legitimate needs to access their funds earlier. It provides a structured way to receive income from your retirement savings while still honoring the spirit of long-term saving. To use Rule 70-T effectively, your distributions must be substantially equal periodic payments, or SEPP. This means the payments must be calculated using one of 3 approved methods and continue for at least 5 years, or until you reach age 59 and a half, whichever period is longer. The 3 calculation methods are the required minimum distribution method, the fixed annuitization method, and the fixed amortization method. The required minimum distribution method uses a life expectancy table to determine your annual payment. The fixed annuitization method calculates payments based on an annuity factor. The fixed amortization method spreads your account balance over your life expectancy, using a reasonable interest rate. Once you choose a method, you generally cannot change it without triggering penalties. An interesting detail about Rule 70-T is that if you deviate from the substantially equal payments before the required period ends, all prior penalty-free withdrawals become retroactively subject to the 10% early withdrawal penalty, plus interest. This is known as the recapture tax. While commonly associated with individual retirement accounts, or IRAs, Rule 70-T can also apply to other qualified plans like a 401k or 403b after you have separated from service. This provides critical flexibility for those who might transition into early retirement or encounter unforeseen life events. Utilizing Rule 70-T gives you a strategic pathway to access your retirement funds when life calls for it, without being penalized for proactive financial planning. It allows you to bridge income gaps and maintain financial security, ensuring your retirement savings work for you on your terms, even if those terms come a little earlier than originally planned.